I'm Bill Robson, the CEO of the C.D. Howe Institute, and with me on the screen is Don Drummond, Stauffer Dunning Fellow at Queen's University and also a Fellow in Residence at the C.D. Howe Institute, and a co-author of the 2024 Shadow Federal Budget that the C.D. Howe Institute released today. I'm going to say a few more things about Don shortly, along with a formal introduction, but it's a pleasure to work with him, and it's a pleasure to appear on the virtual stage with him. I also want, and Addie, if you can show a slide, we've got a co-author who is not sharing the virtual stage with us, but I did want to just mention colleague Alexandre Laurent. There you see him, along with the cover of the document that he and Don and I have worked on. And although Alex is not on the stage, his wisdom and his hard work are on every page of this document, and he is a leader of the Institute's work on fiscal and tax policy. And few people know that better than the members of the C.D. Howe Institute's Fiscal and Tax Competitiveness Council. And it's a pleasure to mention them. I know many are in attendance, and I expect they're going to hit us with some good questions when we get to the discussion part. Let me, though, just in talking about them, say that their input on earlier versions, because we do this annually, of the shadow budget has been very helpful. I also must absolve them for responsibility for anything they don't like. And when you're rolling together a big package like the shadow federal budget, it's not going to be possible to please everyone. Let me, before introducing Don properly, just say a little bit by way of a stage setter for the webinar today. Don and I are each going to make some opening remarks, and then we'll go to discussion. We hope our opening remarks will be engaging. We know that discussion is going to be lively. What I did think it made sense to do is say a few things about why we do this annual project, the C.D. Howe Institute's Shadow Federal Budget. What we're doing, and if you've had a chance to skim through it, you'll have seen this, that they package many ideas that our research suggests would help Canadians succeed economically in a fiscal framework that works and inspires confidence. Why do we do it now? We know that the work on the real thing, what Federal Minister of Finance Chrystia Freeland will deliver in a few weeks, that's well advanced. We time our release in the run-up to the budget partly simply because it gets more attention then. But we also know that coming in this late, I mean, people at the Department of Finance know of our work and they've seen drafts of the budget, but we do know that what Minister of Finance Freeland and delivers in a few weeks and what we are recommending today won't resemble each other all that closely. So why do it at all? Well, one sort of obvious reason is that it's a good place to bring together the various ideas that we think are relevant to federal budgeting. And I mentioned already promoting growth, higher living standards, and then plug them into an actual fiscal framework. So we have a wish list, things that we think are good ideas. And it does include a balanced budget within the projection horizon. And then you've got the actual numbers that the government presented in the fall economic statement, and you have to be able to make it all work within that framework. And the second one, which is sort of a higher level conversation, and we get a lot of feedback about this, and it's very, Don, I don't mean to speak for you, but I know it's a preoccupation for Don, is we're trying to support a conversation about fiscal policy that's quite different from what we're hearing from Minister Freeland and many other commentators. I've used the phrase, many of you will have heard it at C.D. Howe Institute events or elsewhere before, for political science, the idea of an Overton window, which is the range of discourse that people see as acceptable and practical. And the Overton window that frames discussions of fiscal policy has moved a lot since the days of the Chrétien-Martin fiscal consolidation of the late 1990s and the Harper-Flaherty consolidation in the late 2000s. We had what started as sort of a clever campaign tactic, promising modest deficits, that sort of distinguished the Liberals from the Conservatives who didn't think deficits were a good idea, and the NDP that didn't want to have that in the platform because it was a point of vulnerability. And the deficits were never all that modest, and spending accelerated, and then COVID hit, and we had previously unimaginable levels of spending and borrowing that just sort of got normalized. Just to illustrate this, if you go back to the government's last pre-COVID projections in the 2019 fall statement, the last fiscal year in those projections was 2024-25. So that's the budget year that we're about to, that this budget is for, and that Chrystia Freeland's budget will be for. The 2019 statement showed federal spending in that year at $421 billion. If you look, just fast forward to the fall economic statement last year, spending in the 2024-25 fiscal year was shown at $522 billion. So more than $100 billion higher than projected in 2019 after all the COVID measures were gone. Yes, there's a bit of inflation, but most of that is real. Now, the debt comparison is not as straightforward, even if some of the borrowing during COVID was excessive, which it was, but nobody expects all that to be paid down. But still, it's worth comparing the debt numbers as well. By the end of this fiscal year, they're showing debt of well more than 1.2 trillion, and that is more than 400 billion more than was projected in the 2019 fall economic statement. What, justified or not, that debt has to be serviced. And the problem is that too many commentators, in our view, have become comfortable with annual spending that's now running well over 500 billion, so much higher than was projected back then, and debt that is now 400 billion higher than was projected. So let me, I don't want to get too far ahead of the discussion. I certainly don't want to get too far ahead of Dawn, but I just wanted to say before turning the floor over to Dawn that sometimes at the C.D. Howe Institute, we're trying to offer technical advice about policy challenges that are already kind of within the relevant Overton window. But sometimes the job is to try and move the Overton window, and in fiscal policy, it needs to move. We need to talk more about excessive spending and excessive borrowing and excessive marginal tax rates and silly populist tax policies. But now I am very much in danger of getting ahead of myself and of Dawn. So thank you for bearing with me through that introduction of the motivation for this. I already said what Dawn's titles are. You probably know him. You certainly know him by reputation. Many on the call will know him personally. I won't read you his bio, but it's well worth reading. It highlights, among other things, his experience as a federal public servant, where he was on the front line of some of the previous fiscal consolidation efforts that had to be made. In his role with the C.D. Howe Institute, he is very energetic, great source of wisdom and ideas. And when he sees bad public policy, whether it's in healthcare or in climate policy or fiscal policy more generally, he doesn't stay calm. He's very motivated. Dawn, it's a pleasure to work with you, and it's a pleasure to welcome you formally to the webinar and to turn the floor over to you.
Oh, thanks. Well, just as when I actually worked on the budgets back at finance, the starting point is always what's the situation? Are things going well? Are prospects favorable? And our starting point in this context is things aren't going well and prospects aren't favorable. The fall economic statement sort of portrayed that maybe things aren't going that well, but everything will work out fine. And particularly to put a lot of emphasis on their projections through 2055 that the debt-GDP ratio will continue to decline. But let's dig behind that. It's based on three assumptions, all of them pretty dubious. The first one is forever, and the Parliamentary Budget Office does this right through the end of this century. They have the effective interest rate being below the economic growth rate. Bill, you've put this in a very populist term people could relate to. If somebody was going to lend you money at below your expected rate of return, you would try to borrow to infinity and you would arbitrage that interest rate difference away. It's the same thing in the economy. The times when the effective interest rate has been below the effective growth rate are the minority. I get it. Everybody says, but it was that for quite a long time. And he said, yes, it was that for the financial crisis. And look what that happened. That gave us this big debt. It gave us unaffordable housing. That's not been the rule over time. The second aspect is they assume that program spending will remain constant as a share of GDP. Well, let's look at the record of this own government. Program spending in their projection in 2028-29, after they do an expenditure cut exercise, is up 2 percentage points of what they inherited back in 2015. So even the government that's making that assumption hasn't abided by that. And the third is that nothing really happens. Everything just goes along smoothly. And I always think around about 2006, there seemed to be sort of a building consensus in economic communities that the successful record of keeping inflation low and steady meant that there weren't going to be wild swings in the economy. Yeah, things would get a little bit out of hand, but you just needed to tweak interest rates. And no sooner did people start to believe that, of course, we got whacked with the financial crisis, the ensuing recession. We've had SARS before, but we've never had the widespread public health problem that we've had before. And of course, we're having increasing incidents and increasing costs related with climate change. So I think if you look forward, it's kind of the opposite. I think if anything, we should be accounting for more disturbances to the economy. And all you have to do is make very slight tweaks to those changes, and all of a sudden that declining debt to P ratio goes up. And that makes me very worried about the intergenerational transfer as well. I think that young people of today and the next generation will have to devote all the resources to deal with mostly climate adaptation. Is too late for much of mitigation, but there will be some of that as well. They can't really be given a double burden of this debt burden as well. So I think a lot of changes need to be made. I think we need to change how we think on the economic side too. You know, if growth is going along at 2%, we have to keep in mind we've had phenomenal population growth recently. Our GDP per capita is falling. So we need to have something, and the budget should reflect something that increased growth. My final one, I said, is this is about the context. I think if somebody looks at our shadow budget and looks at the cumulative amount that we're cutting out of program spending, you'll say, wow, that's heroic. Maybe that's unrealistic. I like to look and said, what's left? Even after our cuts back to 2019, program spending will be growing 4.7% a year out to 2029, back to when the Liberals started 2015, program spending is growing at 5.2%. So the only reason it looks like we're cutting an awful lot is spending is growing at a phenomenally rapid clip under the projections of the government. We shouldn't get drawn into that game. This exercise of finding 15 billion, that's 15 billion off an extremely high level of spending. It's not what is called for. Much more severe actions called for that, and tilting everything towards enhancing growth. We don't see that in the projections.
Well, thank you, Don. Let me just, before going to the discussion, give a little bit of a flavor of some of the specific proposals, or at least broad directions. I hope many of you have had a chance to at least scan the shadow budget. It would take too long to itemize everything that's in it, although I will say that we were conscious this year that the sort of change of direction, and particularly the spending review that Don's been alluding to, really needed to be centerpieces of the budget. So there are a lot of interesting ideas, including ending the deductibility of contributions to strike pay, but then not subjecting strike pay to tax, which is a very weird one. That not everything made the cut this year. But if you've had a chance to look at the shadow budget, you'll have seen that in addition to some substantial savings that we think are available from federal program review, and particularly cutting into the federal government's operating costs, which, as I think everyone knows, have really grown spectacularly along with the headcount. We have advocated that there be a return of the GST to a 7% rate. Now that is definitely outside the Overton window. We're not going to see that in the shadow budget, and it's also not likely that it's going to be a popular election plank for any party in the upcoming election. But it does make a key point. The GST raises net about 10 billion per point, and as spending has continued to rise the way that it has, financed by borrowing, you're building some kind of tax increase into the future. And just to kind of put some quantity around it, we thought it was helpful to say, if you want to right the fiscal ship and you want to make a little bit of progress, a down payment, if you like, on some other tax changes that are urgently needed, this is the sort of thing you need to do. So we do have an increase in the GST of 1 percentage point in the next one point per year for the next couple of years. And that is a substantial amount of money, which would certainly, along with some spending restraint, get you on the path back to a balanced budget. What else is in the shadow budget? We are concerned that personal income tax rates are too high and cut in at too low a level. So we've got some tax relief there. Alex Laurent thought it would be a nice idea to adjust the middle tax bracket downward so that you ended up collapsing it with the bottom bracket. That provides a lot of tax relief and some behavioral response. Doesn't all have to be at the top end. We've also got some indexation of some tax thresholds that needed indexing. We make a down payment on a lower corporate income tax rate. Canada has lost tax competitiveness as other countries have been catching up with lowering their rates, and particularly in 2017 with the US tax reform. And that's probably one of the reasons why we have seen such dismal capital investment over the last few years. Don referred to declining per capita GDP. Along with that, we have declining capital stock per worker. Never happened over this period of time in our lifetimes before, and we think lower corporate income taxes would do something helpful there. We have a few tax measures that we think are unhelpful related to the housing side, where we're stoking demand but not doing anything to help with supply. And we also take aim at a few tax measures that we think are essentially just populist tax measures, bad tax policy where you've got targeted tax increases, for example, on financial institutions' profits or on intercorporate dividends. And there are some other examples of taxes where we just think the amount of revenue raised relative to the compliance cost and relative to the damage done to the integrity of the tax system is too, it's just not worth the effort. I'll also mention, by way of fiscal measures, that we are looking at measures affecting retirement saving. We would like to see people able to save more outside of defined benefit plans. We would like to see people forced to draw down their savings less quickly than they currently need to once they get to the stage where they have a RIF or an equivalent kind of vehicle. And we've also got something, this will be for a minority taste, but there's no reason not to do it. It'd be a good move, making life annuities available in TFSAs. I'll mention the more generous tax treatment of medical expenses because it ties back to one other thing that we're saying just about the spending trajectory generally. Medical expenses are not treated very generously under the tax system. They're necessities, they're not luxuries. Why would you not simply exempt them entirely? We make a move in that direction. But this is also in a larger context where we've got the federal government under a lot of pressure to produce a pharmacare program. And we've had a dental program put in place, and there's some prospect of expanding that. And what we're saying is, no, don't do those things unless you can fund them out of other sources. Hold off. We cannot bring on these very large price tag programs that, with an aging population particularly, are going to escalate into the future and put future federal governments into that tighter a fiscal bind. I'll just round it off before going to questions by mentioning immigration is not a budget topic strictly, but it's clear that a lot of the pressures that we're seeing in housing are related to the fact that the population surge has gone beyond what we're really easily able to cope with. So we do say something about that. And we take one more kick at the supply management can. Again, not expecting any action on that soon, but that's an area where the Overton window definitely needs to move. When we have all the attention that's being paid to grocery prices and some idea that if we could just squeeze grocers' margins, which are not that big in the first place, down a bit more, we could do something about grocery prices. It just sits so badly alongside a cartel that makes 4 liters of milk cost $1 more in Canada than it does in the United States. So we had one more shot at that. Thank you, everyone. I hope that was a reasonable overview. Don, do you want to say anything just before we go to the discussion? Because I might have left something out that you...
Well, just one quick thing. As I said, the proposal to increase the GST might not be popular. GST never fares well on polling on the GST itself. It fares very much better if you pair the questions. Would you rather pay the GST or the personal income tax? People get that you don't pay the GST if you don't consume. They also get there's nothing you can do. If you make $1 of income, you're going to pay the personal income tax. And if you manage to save a little bit, you'll pay it again. So I'm not sure that a tax shift would be unpopular. I think people do get that that is a better way of managing their tax burden, more on the indirect taxes and less on the income tax. And of course, to a small degree, we're trying to do that. As you said, it's kind of a down payment on personal income tax, but the hope would be we could get those marginal tax rates, which are very high in Canada, particularly at modest income levels, down.
Well, Don, thank you for that. Let me now switch into impresario mode or MC mode, if that's the right way of thinking of it. Remind everyone, we all juggle different kinds of video conferencing platforms and they constantly update their specs. So even if you've used WebEx a lot, you might not have used it recently. In the bottom right corner of your screen, you should see a 3-dot menu. And if you press that, if you don't have the Q&A screen open already, then you ought to see the Q&A screen pop up. And I think actually we've got some instructions just in case I said it wrong or didn't go in. And so please do make use of that. If you chat, we may or may not see it. I may or may not see it. I mean, I'll try to take everything that comes in, but the Q&A field is definitely the better bet. While we're waiting for questions to come in, Don, I touched a little bit on some of the tax measures that are related to aging, but you mentioned intergenerational fairness as a key motivation for our overall fiscal framework, and you've got some other concerns as well when it comes to health spending. Do you want to talk a little bit about what we have been thinking about when it comes to what the federal government can reasonably do in that area?
Yeah, well, I find one of the most interesting things in public policy is the aging of the population is absolutely the most predictable public policy of anything. We've known that the day was going to come when the baby boomers were going to get 75 plus, and we've known that for decades and decades. And yet it's simultaneously the one that we've least prepared for. And I find it's an interesting paradox to understand the political response, because the knee-jerk reaction is, yeah, we get it. We need to build more long-term care institutional beds. And yet I don't think a senior has ever stuck up their hand and say, I want to be into a long-term care institution. They want to live independently in the home as long as they can. And if they're not in their home, they want to remain in their community. And other countries, not the United States, and of course, that's maybe why we don't do it, because we just singularly look there. But in most of the European economies, they offer much better services, home care and community based. Britain has all kinds of age stratified communities, and younger people work on social and mental concierge desks and the like. In Denmark, if you're having trouble getting out of your bathtub, you just call your community association and come and puts a bar in your bathtub. And if that can keep them above all out of the hospital, if that can keep them out of a long-term care, so much the better. Now, of course, much of this falls into the provincial jurisdiction. You would hope for get some federal leadership, and we've been getting some pilot projects from the federal government to move in this direction, but we need to move the whole thing. Also giving you a mathematics lesson, I can't tell you how frustrating it is to hear the premier say, yeah, we get it. We're going to build X thousand more long-term care beds. And they don't even realize more than the X thousand is coming out of commission. The famous 4 people in a room in Bob Cajun separated by a sheet, which caused all the fatalities and when the original outbreak, those things are being decommissioned as they should. So we're not increasing that supply. We're going to have a doubling of the 75 plus. We're not going to serve that clientele whatsoever, and certainly not to their satisfaction. And they're at least a leadership role, if not a financial role for the country. But, getting off the subject and federalism, it doesn't have to always be a federal leadership. Why can't the provinces do it together? Why is that something like that not being done through the Council of the Federation? I guess we'll get dribs and drabs of little policy experiments among individual provinces, and maybe that will spread. The whole model of care, we only have slightly over 300 geriatric specialists. We only have slightly over 400 rheumatologists in Canada. Again, you would think we would have been planning for the demand for their services going to increase, but it's not. That will fall to family physicians, but they're in short supply as well. That will fall to nurse practitioners, but there's only 7,000 nurse practitioners. So again, this has not been thought whatsoever, and it's crunching us up. And of course, just the aging itself will slower the growth rate. It'll raise pressure on healthcare, make it all that more difficult to reduce that debt-GDP ratio, and pass yet another burden onto the young people. These are the kind of serious problems why we feel compelled to try to think a little bit out of the box, because these are serious problems that need to be cracked.
Well, thank you for that. And we have a question from Michael Wolfson related to that. You mentioned the jurisdictional issues, and we sort of debated how far to get into that in the shadow federal budget. Before we get to that question, though, Christian Ouellet was in first. He mentions that we have a budgetary deficit and an infrastructure deficit. And the question is, what's worse? I do have a thought or two on that. Don, do you want to come in first, or do you want me to?
Well, just on the deficit itself, we don't talk about the very simple concept of a cyclically adjusted budget balance anymore. That seems to be something in the 70s, 80s, but there was some merit to it. Only with the fourth quarter of 2023 did the Bank of Canada say we have a little bit of an output gap. They've actually had aggregate demand above aggregate supply. There is no reason from the macroeconomic perspective to be run deficits whatsoever. And yet, in the fall economic statement, a big deficit's run all the way through 2028, 2029. That's just adding to the inflation pressures. And mild satisfaction, the debt GDP ratio comes down, but it just barely comes below 40%. It's still way above what it was pre-pandemic. And it was a good thing it was more modest when the pandemic hit, because it gave the flexibility response. But we need to restructure that flexibility, because believe me, there will be other shocks come. We can't fall into that naive position we had back in the mid 2000s that if we control inflation, everything will be all smooth. Big shocks are going to come. We have to be prepared for them. Yeah, the infrastructure, but this is the allocation of spending, less consumption, more investment. The total is too big, but the allocation is all wrong as well.
I will add, thanks, Don. I will add that one of the things that really irked me about the original commitment to run modest deficits to finance infrastructure was because it just showed, and it kind of fed a misunderstanding about how government budgeting works. The federal government, like provincial governments, uses accrual accounting for capital. So when you do an outlay, you turn cash into a physical asset. That stays on the positive side of the balance sheet. The expense comes as you amortize it, as it delivers its services over time. So you don't actually run deficits in order to build infrastructure. That's capital spending. It creates an asset, just like your mortgage debt is offset by the fact that you now have a house to live in. So it's just a fundamental misunderstanding of what it would look like for the federal government to invest more in infrastructure. The second point that I'd make is that the federal government is not a capital intensive operation. Municipalities are super capital intensive, and the difference between cash and accrual budgeting for capital is massive at the municipal level. It's also much more important at the provincial level. The federal government doesn't actually own a lot of assets, and so I would say that many of the infrastructure problems are ones that really need addressing at the provincial and the municipal level. The federal government would do a much better job if it focused on the infrastructure that is within its bailiwick. So that's my comment there. I promised that we would get to Michael Wolfson's question, but I will, if I may, go to Raza Hassan, who was next in line, because he asked about the possibility of reducing debt immediately by privatization and asset sales. Maybe an issue, as our crown corporations are generally profitable, but did we look at that? The short answer is that in this shadow budget, we did not look at that. It's a very important topic. Many of you will know there's an argument going on right now about the degree to which the tendency of our big investors, the pension plans, but not only the pension plans, to invest abroad rather than in Canada is a problem that needs addressing with some kind of regulation or moral suasion, as it used to be called in the trade. And part of the problem that any big asset manager will tell you about is that there isn't a lot that in Canada of the sort of thing that they would like to own. And a lot of the infrastructure they would like to own is actually in that category of things that governments own, with the airports being right at the top of the list. It would make a lot of sense for the federal government to, I think, to sell off airports. Ben Dacus, colleague, has done work on that. There've now been hundreds of airport privatizations around the world, and there's plenty of evidence that privatized airports have better performance across a whole range of metrics than was the case with the ones that stayed under government ownership. So it's an important topic, but we didn't address it in this shadow budget. The amounts that we're talking about by way of debt are just so big that although I think it's a good idea anyway, it doesn't really solve the issue. Don, I'm going to jump to Michael Wolfson's question, not to squeeze you out here, but he did ask about the fiscal transfers to the provinces that reflect, as you know, major issues in healthcare, pressures that are likely to grow. And so he asks, what are our views about those future fiscal pressures? I'm happy to turn the floor over to you on that one.
Well, I am troubled by a rigid rule that something like the Canada Health Transfer would grow with nominal GDP. We know that the population aging has been adding about 1 percentage point to growth just by itself. And we know we have very serious deficiencies, the 14% of adults that don't have regular access to primary caregiver. But this again comes back to this allocation. There are needs on the infrastructure side. There are needs on the health side. This is why we need a reallocation of the spending. I don't think that's the reason for the overall spending, but some of those elements of consumption have to be pared back so we can allocate it where Canadians need it more. It's kind of funny if you look at the, if you came from another universe and look back in Canada, you think, well, this country seems to have two really big problems: access to primary care and access to affordable housing. And the fall economic statement didn't address either. Now, you could say neither one of them is directly in the federal responsibility, but the federal government does cover the lay of the land and is responsible for roughly 40 million Canadians. It should at a minimum be working with provincial, territorial, municipal partners to address this, and yet not doing very much.
Yeah, Michael, thanks for the question. Even in the area of long-term care, we were debating as we were putting this package together how much of this is really within the federal bailiwick. Arguably, none of it. How does the federal government exercise effective leadership in healthcare? Well, some kinds of incentive funding probably are helpful, but when it comes to actually, ensuring that the money flowed in the directions that it was supposed to and did the things that it was supposed to, money being fungible, you can never really be sure. So we thought perhaps a time-limited program to try and shift priorities in that area. But I think Alex Loran and I have written separately on this. When it comes to kind of a relatively open-ended commitment by the federal government to finance these provincial programs, we're pretty wary about that. Even when you establish a formula like the one that Don referred to, which has been kind of formally in place for a while, when you look at what actually happens year to year with federal spending, it's pretty clear that the provinces are not spending their own money at the margin. The feds repeatedly come in with various types of top-ups and bailouts, and so that creates a bit of a budget discipline for the provinces. Anyway, thank you for the question. I won't continue on because we actually have a fair number of other questions. But Michael, by all means, come in again if you're not satisfied with that. Just before going to Jamie Gollenbeck, who's next in the Q&A, a number of questions have come in the chat. And you'll pardon me if I don't get to those right away, I hope. If you have put something in the chat you'd like to see us address, please improve your odds by putting it in the Q&A. Just cut and paste it in there, and it'll be a little easier for us to deal with. So Jamie, thank you for your compliment. He says every year the CD Houndstooth recommends a variety of thoughtful tax measures, and then he makes a comment about sort of political orientation, a tendency to go after high-income earners. And he mentions particularly, and I will mention this one, the proposed changes to the alternative minimum tax, because I know somebody else is asking a question about that. What's the chances of those things seeing the light of day right now versus something that might become likelier in the future? A delicate question, but I talked about, because we are a nonpartisan organization, I talked about moving the Overton window, and I think that part of what we're doing in our shadow budgets, or trying to do, is to raise the profile of issues that lately haven't been all that high profile, and particularly the ones that relate to the effect of high marginal effective tax rates on incentives to work, incentives to be in Canada at all, you may have seen a column that Parissa Mabubi and I wrote today about the tendency of immigrants to leave Canada. So, we've got some problems to address on that front. And that sort of thing was front and center at the time of the Chrétien Martin consolidations. And previous to that, we actually saw some significant cuts in personal income taxes, and we saw some significant cuts in corporate income taxes and marginal effective tax rates. And our investment performance and our growth performance actually did improve at that time. So we are certainly trying to raise the profile of those issues and the disincentive effects that we've now got built into our system. And with respect to certain particular issues like the alternative minimum tax and particularly the very likely damaging effect of reimposing capital gains tax on donations of listed securities, I think some of those measures are in fact possibly even within the current Overton window likely to be addressed, because it's very hard to make a case for a tax change that actually isn't going to raise any revenue, and like literally might not raise any revenue, but would do such collateral damage. Don, did anything I said in that answer or in the question inspire a separate thought in you?
Well, it was put in the context. It's not going to happen because it's not favorable politics. But if we put it on the proper context, yeah, these so-called attacks on the high income earners are not going to raise money. So what's the point? Do people understand that? And perhaps one of the biggest impacts of the alternative minimum tax is you're going to lessen charitable donations. Who's going to suffer from that? Yeah, it seems like a change in taxation for somebody who has wealth, but the impacts is people who most need it. So if that gets out there and is understood, then I think these things become feasible to change.
Thank you. Jeff Trossman has asked a question, and in fact, I feel like I was just front running him because he mentions revoking the measures related to charitable contributions, but we didn't go into detail on other aspects of the proposed changes to the alternative minimum tax, including treatment of loss carry forwards, whether those things should be reconsidered. Jeff, I'm not going to satisfy you with a short answer to that question, I know, but I might just take the opportunity to say that the existence of the alternative minimum tax in the first place it's not quite like the general anti-avoidance rule, but I'll mention that in the same sentence anyway, that by putting such a regime in place, you are really kind of running a flag up that says we don't know how to design a proper tax system. If the regular provisions that exist in the personal income tax are allowing people to do things that you think they ought not to do, then change those provisions. Once you start putting backstops like the alternative minimum tax or general anti-avoidance rules in place, you are really undermining the integrity of the tax system. It lowers the imperative to fix the problems that caused you to create that kind of a backstop in the first place. You're making tax planning much more difficult for people to do, much more expensive. Only people who can afford really good tax advice are able to cope with these things. And so in an ideal world, I would say we would not have any such thing in the first place. So, Don, I don't know if you want to come in on that. Michael Wolfson came back. Michael Wolfson came back just pursuing the question of healthcare, mentioning a topic that we didn't cover in this year's shadow budget, but Don, you've mentioned it before, and I know it's a topic that's very near and dear to your heart, so let's deal with that. Michael says, major start would be having adequate data in order to run things more cost effectively. Current health system is always looking for more money, but never looking at interventions that are wasteful or even iatrogenic. Any doctors in the group, please don't be offended by the suggestion that occasionally treatments leave people worse off than they were before. Don, any comment on that?
Well, at the meeting of the federal government with the provinces and territories in early 2023, it seemed they walked out with an agreement to get better data, particularly on health outcomes. And for about 6 months, everything seemed to be like it was going to go in the right direction, and then it seems to have fallen offside. So that's very, very discouraging. So I'm not quite as pleased or optimistic on that front as I was a year ago. We need to keep pressing on that.
Michael is very active on the keyboard, and because he's doing it in the Q&A, not the chat, I'll mention that he says it's essential to distinguish charitable organizations from charitable foundations, often used for tax planning, not necessarily doing good deeds. So our proposal needs to be better nuanced. I will mention that we've actually got ideas for how you would relieve capital donations of non-publicly listed securities from capital gains tax. There's disagreement about this, and Michael's put his finger on one reason for the disagreement. But if you are in a situation where somebody's economic resources have not gone up at all because their capital gain or whatever income they're using to make a charitable donation with has all gone out the door, then it does seem wrong to have a tax liability associated to it because their economic resources didn't increase. Now, Michael will be saying, but they're, good point. We have seen we don't mention this in the shadow budget, but an increase in distribution requirements. Maybe that's a good thing. But if you're thinking about ways of forcing faster disbursements, you might also think about allowing charities to refill their tanks a little more easily as well. Jeff Trossman did put his chatted note into the Q&A. So Jeff, thanks for that. We have another questioner who did not. It's really about trade policy. We didn't build anything in trade policy, and we certainly didn't envision any higher tariffs. In fact, with the proposals to dismantle supply management, that would be a reduction in tariffs that don't yield much revenue, because the point of these tariffs is not to raise revenues, to keep products out. But our questioner's particular concern is with trade with China, and whether there's anything to be said about our trade relations with China. Our questioner particularly has EVs in mind. Don, I don't know if there's anything that you want to say particularly about that.
Just a minor thing. It was one of the many things that we worry about into the future when we set that context, that I think we can expect for the next 10 or 20 years that the international economic order is going to be more hostile than it has been in the past. And there's just a lot of attempts going around to reshore, and Canada probably has to do that as well. I will cue off the one word that you did say, and this one caught my eye in the chat, a question about subsidies for economic development, corporate welfare support. We didn't really talk about it. We're urging a better job be done on spending reviews. As we know, there is a requirement to do periodic reviews, but basically they amount to, we spent $400 million and that created a couple of jobs, therefore close enough. And we have to get over this. And if you spent $400 million, it means you plucked $400 million out of somebody else's pocket. So yeah, you spent it there, but somebody else didn't spend it. That doesn't count. That's a wash. But in raising that taxes, you actually create economic distortions, and you got a deadweight loss in the administrative costs. The bar has to be set way higher than that. And I noticed that one of the tests that's been applied of late, and it got applied on the EV battery subsidy, which is absolutely immense, was it will return its money. It'll pay itself eventually. And there was a dispute with the parliamentary budget office to take longer, but that's not adequate either. Just because it'll pay itself, that does not mean that there's a positive social rate of return from it. The money that's being allocated there could be put to a better use, but we're not testing that. So we want a regular review of that, and we want to look inside that great big box of the tax expenditures. One or two of them, if we're lucky, get reviewed every single year. Bill doesn't like to give the title, but even the ones that aren't integral to the tax system, there's over 100 billion of them sitting out there. Many of them operate exactly the same as spending programs, but they're shielded from regular review. We have to look at those two, and they have to satisfy that there's actually a social benefit generating from that. And we don't know that. I suspect there's not, because it didn't mention, I've never liked the small business deduction. I get that when you cross the threshold, you still have a positive rate of return and you have incentive to do that. But I don't think it's a sheer accident we get this conglomeration of corporations just below where the limit is. We seem to idolize small businesses and almost encourage them to stay small, where bigger ones are more productive, they're more likely to export, they're more likely to invest. And we don't have all the answers, but we recommend let's crack this, not to penalize small businesses and anything else. Let's create the conditions that we create small businesses at a rapid pace, but let's create the incentives for them to continue to grow, not to sell out a cap when they get a 500,000 or whatever, because a lot of that seems to happen in Canada.
Yes, we do. Thank you, Don. We do say something about that in the shadow budget. We know that the lower small business tax rate, or the small business deduction that lowers the tax rate, is a very popular item. And we know that suggesting that it should go up or converge with the regular corporate income tax rate is not welcome to everyone. But I would love to see the gap close through reductions in the regular corporate income tax rate. Not necessarily so keen on seeing the small business rate rise. But in the meantime, as Don has said, and we take a stab at it in the shadow budget, if you can figure out ways of making that lower tax rate available to young businesses, but as they grow and mature, then the passage of time will take them out of it. Then you would remove this disincentive effect that causes people to bonus out and split businesses and do various other things that may be partly responsible for the fact that businesses in Canada do seem to stay small. And when you compare our profile industrially to that of many other countries, you notice how many small businesses there are in Canada, and we know that small businesses tend to be less productive. So as we're thinking about ways of goosing productivity growth and growth in living standards, it just makes sense to look at that. There's a question, and it's in the chat. Please, we're concerned about incentive effects. Please don't use the chat if you found the Q&A feature. It's easier for us, but I did want to respond to a question in the chat about research and development and innovation contributing to enhancing Canada's economic growth. Quick sort of big picture comment on that. Canada's pretty good at supporting the front end, the research side. In fact, it's a massive industry, but we don't think it's super effective. And where you see a really big fall down in Canada is with the commercialization. A lot of intellectual property that's developed in Canada gets commercialized abroad. And as my colleague Daniel Swanen has demonstrated in a couple of reports, we actually have a surplus, if you think of the trade balance, on royalty income. But when it comes to paying for the services from intellectual property, we have a deficit. So it looks a little bit like we might be developing ideas here that get commercialized abroad, and we buy the things abroad. We're conscious of the need to do something in this area. I referenced very low business investment already. Canada's investment per worker in intellectual property products is barely a quarter of what it is in the United States, and that's a gap that's really opened wide over the last little while. One idea that kind of appeals to us, we're not fans of different income tax rates on different types of property. But one area where we've sort of swallowed our reservations in that area is with the idea that you might have a lower corporate income tax rate on the proceeds from intellectual property when it's commercialized, not just the sort of the royalty phase, but once you've got income that's derived from it. U.S. tax reform in 2017 kind of went a little bit in that direction. And if you think of it as a down payment on a more general lower corporate income tax rate, it becomes a bit more of an appealing thing. Lead with that. Maybe that does promote a little bit more commercialization of intellectual property endeavors in Canada, which, as I say, is where we really tend to fall down. We do not do too badly on research, but when it comes to embodying the new ideas that are generated, whether here or abroad, in new products and services, Canada is not doing so well. Dawn, unless you want to jump right in on that, I'll go to a question from Alf Worth. So Alf addresses the question of, do you need to hit the wall before you do something? And he mentions some well-known cases, New Zealand, and arguably Canada was close to hitting some kind of a debt wall ahead of the Chrétien Martin consolidation. Certainly there were provinces that began to have trouble rolling over their debt. And Alf mentions that we've got some very big other debtors in the world who are either in trouble or on their way to it, including the United States and China. So is that in the cards? And I suppose, going from prediction to thinking about how fiscal policy works, is that what it'll take?
I think the prospect hitting a wall may be helpful, but probably not realistic. Let's put it back into the context of, you mentioned the mid-1990s, our debt GDP ratio was around 70%. It's a little over 40% right now. we were spending over 30 cents of every revenue dollar in interest on the public debt. So, the MPs always used to come back from the break and said, everybody says they're not getting their money's worth from their taxes. And well, they're not. They're getting 70 cents back for every dollar they put in taxes. It's 14 cents on the dollar right now, which is bad. I mean, that's siphoning it off, and that's higher than it should be. But I don't think we can realistically say you're going to hit a wall. It would probably be helpful if we could say so. It's more of it just creeps up and it just keeps going on and on. It's more of the taxpayers' money ciphering for things we've already consumed in the past. So less of a building of a capacity to build for the future, to handle the shocks we're going to have to the future. It doesn't lessen the reason to add, but it's not like you've said, we absolutely have to do this dramatic thing. We absolutely have to do this in the next year. We're pressing on that front, but I don't think we can realistically say you're going to hit a wall if it's not done.
Yeah, it could happen certainly, but I think it's not. It's a bit of a perverse hope. Yeah, it's better if you're digging yourself into an endless credit card hole. It's actually potentially doing you a favor if you hit your limit and you can't go any further. But the criteria that bond traders or rating agencies use in thinking about whether to buy someone's debt are not very directly connected to the welfare of the people on whose behalf the borrowing was done. If your creditors think you're good for it, then they'll keep lending to you, even if the money is being used in foolish ways. And I think a lot of the spending that's happened lately, especially on the federal government's own operating costs, I mean, it's pretty hard to argue that there's a larger return to society from that. And so the money is not being used in particularly useful ways, but we're continuing to get it. One thing that I'll just mention quickly, we don't spend a lot of time on it in the shadow budget, but when thinking about the debt burden of the federal government, it's important to look not just at what's on the outlay side, but also on the investment income side. The debt figure is a net figure. The federal government has financial assets as well as liabilities. And historically, the financial assets have paid quite healthy returns, certainly compared to the book value of the investments. And so our net debt servicing cost, which isn't the more widely referenced number, has always been lower than our gross debt servicing cost. But that's changed a little bit lately. The Bank of Canada bought a whole lot of bonds, which lost value. So the Bank of Canada is not paying the dividend that it used to. And in fact, it's going to not be paying the federal government even interest on its deposits for a while. And the federal government's been using its balance sheet very aggressively lately. We keep hearing about investments made by the Canada Infrastructure Bank and so on. And it's reasonable to ask, is the investment income coming from those things going to be as healthy in the future as it was in the past? And if it doesn't, in fact, the net cost of servicing the debt is going to be going up much faster than what the usual figure on the expense side we look at indicates. And people aren't generally following that right now. I think if anybody from Moody's or DBRS is on the call, they can correct me. But I don't think that the debt rating agencies are looking at that sort of thing very carefully right now. And that's one thing that might cause a little bit of a sudden increase in discontent and concern, is if we find that the federal government's investment income, which is buried in the budget projections, you don't see it very clearly. But if that turns out to fall short, then in fact the fiscal profile gets considerably worse. We're getting close to the end, but we've got a couple of challenging questions. I'm just going to quickly, please excuse me, everyone. I saw something else come into the chat just now. Let me go back to the Q&A, and I'm going to pick up on the question. I'm sorry, I'm hopping around here. Oh, there's a question here about controversial measures that might not have made all contributors or reviewers of the shadow budget happy. So Anna invites us to talk a little bit more about things that might not have made the cut and how we were thinking about that. Don, is that something you want to take first stab at?
I think we're all too stubborn to accept anybody's advice not to put anything in. I can't think of anything that we were proposing that anybody said we shouldn't do it. It's funny, just one comes to mind because it kind of stunned me when I saw it. Is we are proposing reducing the age amount. We express the philosophy, why does anything in taxation have to do with anybody's age? and we reduced it. And the question said, why would you just reduce it? Why wouldn't you get rid of it? And I go, oh, blah, blah, blah. I'm not quite sure why. And then we kind of threw our hands around and we said, well, once we get to the age of entitlement for OE security of 67 or closer to then we can come back and do that. But I didn't think that was a great answer, but that I kind of like that comment, and I didn't have a great response to that one in particular.
Yeah, the moving of the Overton window, that metaphor, if it's a metaphor that I mentioned earlier, we are occasionally wary of moving the frame so far that none of the original, what you could see through the original window, none of that is visible. In the past, and this was at my instigation, we had recommended a higher tax on transportation fuels, higher GST rate. And part of that was a little bit of a put your money where your mouth is. If you're serious about mitigating greenhouse gas emissions, then let's confront people with the true cost of it rather than using regulatory measures that are going to result in an effective cost per ton of CO2 not emitted that is much, much higher than what you get with a carbon tax or a variation on it, like higher GST rate on fuels. We didn't put that in this year. It was so clearly a non-starter that it caused some people to say, look, this just can't be serious. And with the overall conversation around taxing CO2 emissions, I won't say carbon because it's just like not quite the right term. But given where it is right now, it just seemed like a bridge too far. But you could say the same thing about the GST increase. Are we really serious about that? What does the fiscal framework look like without it? And you can still get to a balanced budget, but the GST is a fairly large chunk of revenue, and we thought it made sense to have that in there just to indicate, the tax mix is wrong. I'll stop there. There are other items from past shadow budgets that didn't make it into this one. As I said at the beginning, we were really trying to narrow it down a little to deliver a few more messages that were quite focused. Actually, since Don mentioned the higher age of OAS entitlement, I'll say we did put that one in. We know that's a tough one to swallow. It was in place. It disappeared again. But I will say that if you raise the regular age of entitlement in stages over time, as was originally proposed, and now that we've got flexible age of receipt so that you can still take it early at a reduced rate, if you leave those provisions in place, it makes just all kinds of sense to move ahead with that. I hope I'm not guilty of having talked the clock out here, but I do see now that we are at almost at the bottom of the hour. Don, over to you. If there's anything that you really will regret not having had a chance to say if we close up before you get to it.
It may seem a minor thing, but we recommended putting back all the forms of energy back into the carbon tax as you raise that. And I only raised this insight into my strange mind. I actually had a dream the other day that I was in a class and I was asked what my worst public policy I observed recently was, and I chose exempting the heating oil from Atlantic, not because of the significance of this measure, but once you do that, you cause the whole thing to collapse. And I knew that actually the moment that measure was done, I said, that's the end of the carbon tax. It's just going to have holes picked in that. So it may be difficult once you pull the plug on that to refill it, but we've seen that expand. But if we're going to do something, I think the carbon levy is one of the major tools. And if we're going to have a carbon levy, it has to apply it evenly. And let's say it has to apply on the source of one of the biggest emitters of carbon tax. It made no sense to do that whatsoever. And I think it's just from a climate perspective, and I think even from a political perspective, it was absolutely a disastrous move. And we try to address that in the shadow budget.
Well, Don, thank you for mentioning that. Yes, indeed. Almost prompts an editorial for me, but we are at the bottom of the hour. If we didn't get to your questions and comments, and I know there were a few, I do thank you very much. Thank you also. We've got some compliments, Raza, Charlene. Appreciate the shout outs there. It's been our pleasure to do this. I see Peter Hall has some clapping hands going up the screen. So thank you very much for attending. Don, thank you for your efforts on this. And even though we didn't have Alex Laurent on the screen or in the frame, so to speak, it's nice to acknowledge his contributions as well. On a housekeeping note, very quickly, but very important for anybody interested in trade, we have Ailish Campbell, our ambassador to the EU. That's on March 7th. We also have a slide, I think, advertising. Yeah, there we go. Labor shortages and SMEs, March 21st. Still very much of an issue, notwithstanding the very strong population growth that we've seen. I think there might be one more. Do we have the risk managers for the pension funds? Oh, well, we're promoting, visit the CD Howe Institute's website. There's lots more very lively events program. We appreciate your attendance with us today. We look forward to seeing you in person. And Don, I'll give you a round of applause.
Thank you.
Thanks, everyone.
Bye.